Hi guys, welcome back to the channel where I explain the all-in-one loan to hopefully the masses. It is a fabulous loan product. It's not right for everyone, but it's a really great one. And my goal is to tell more and more people about this product. We're going to do a really quick overview here of the mechanics of how the sweep works, how the interest savings works, how access to equity works. So stay with me. It's going to be a quick one. This is a purchase of a $500,000 home, putting 20% down, $400,000 loan. Income deposits into the account are $10,000 a month. This individual has all expenses of $8,000 a month, meaning they have $2,000 left over at the end of every month. Okay, so let's get into it. I'm going to do really broad strokes here, really big numbers and really broad strokes. So this individual is depositing $10,000 a month into their checking account. With the all-in-one loan, we open a checking account and attach it to your mortgage. So that $10,000 comes in. Our mortgage balance starts at $400K. We're going to sweep that over same day that that's deposited. We're going to reduce that mortgage balance. So it's going to go from $400 down to $390. Boom. We're going to calculate interest daily on the all-in-one account. So the advantage is pretty obvious. You're now paying interest on this number versus this number. Now, again, I'm going really broad strokes here, but let's now talk about our expenses coming into the account. So we have expenses of $8,000. That's every single expense they could possibly have. $8,000. So this account is going to trigger automatically. This is all done automatically, nothing manual about this account. So when this debit comes in, the account will be triggered. We're going to transfer that $8,000 over to the checking account. So that's automatically paid, the bills that come in. That's going to then increase our mortgage balance, right? By $8,000. So we're back up to $398,000. Okay. Again, this is a very condensed, boom, end of the month. All right. We are now paying for, again, broad strokes. I'm sorry I keep saying that, but it is. We are now paying interest on this balance versus this balance. We have reduced the principal on this mortgage by $2,000 in 1 month. In 1 month, guys. What does that mean? That means that in the next month, all things considered, very similar, we're going to reduce it by another $2,000 and another $2,000 and another $2,000. So by 6 months into this, we've now reduced the balance from $400,000 by $12,000, and we're paying interest on a balance of $388,000 versus $400,000. Now take that time over time over time, and you'll see how you can pay this loan off substantially quicker than a 30-year loan. We'll talk about that in a second. So for we've got $2,000 that we've reduced the mortgage balance now. Let's do that over 1 year's time. We have $24,000 that we have paid the mortgage balance down, and that is now equity for you, right? That's your money. You've paid that down on your mortgage balance. You have access to that at all times. So let's say you need to put on a new roof, you have unexpected medical expenses, anything. You simply write a check and you have access to this at all times. Okay? Now, don't touch it. You're going to pay this off much quicker. If you need to pull out, it's there for you. You don't have to go get a second loan. It's right there. That's why it's called the all-in-one loan, right? So you have access to your equity by simply writing a check. You are paying less interest because you're paying interest on the lower balance. And number 3, you're going to pay this baby off quickly. Am I right? Let's look at the projected number. The projected payoff of this specific scenario, I'm going to go to my notes, but the projected payoff on this is 11.3 years versus 30 years. And the interest savings goes from $417,000 on a 30-year to $176,000 on the all-in-one. You guys, it's not rocket science. It's cash flow. If you have cash flow at the end of the month, the all-in-one might be a great option for you. Okay? Money's coming in, we're paying it down, we bring it back when you need it, so forth and so on. And again, if you have that positive cash flow at the end of every month, this might be a great loan for you. So give us a call. Our phone number's in our bio, email's in our bio. You can set up a Calendly appointment so that it's a guaranteed time to talk. And let's look further at the all-in-one loan. Thanks so much for watching.